Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Erin's with us around the table. Erin, good morning to you.
Good morning.
Are you saying the bar's a little bit too high? Maybe valuations are a little bit too stretched stateside around this theme?
So I don't think that valuations are actually that stretched at this point, and I think that that might be a little bit of a shock to say, but at the same time, if you look at where Nvidia is trading, a couple of years ago, 3 years ago, it was trading at about 31 times. It's trading at that same valuation today. That said, there's a lot of attention with the stock up as much as it is year to date. All eyes have been on Nvidia, and I actually think that there's opportunities outside of just Nvidia to play the AI theme. And so I like looking under the surface at less discovered names.
Well, let's get to opportunities in a second. Let's talk about what people have been doing stateside. They've been looking to utilities. They're up 8% month to date.
Yes.
When we think about what's at risk a little bit later on this afternoon, is it just the semis, the chips, the whole of tech, or is it the whole of this market?
Well, so the utility names that have been really the ones in the firing line for people buying right now have been the ones that are more IPPs, that are more independent producers, that have the ability to really lean into the AI theme, and that's really brought the entire utility market up. I actually think this is one of the sweet spots of the markets. Utilities have been under-owned for a very long time throughout most of last year. They've underperformed pretty significantly. I think now with rates starting to peak and with the Fed likely starting to cut at least towards the latter part of this year, utilities look really attractive. That said, yes, if Nvidia goes down today, the whole market's going down. I think that that's probably a short-term dip, and you likely buy, because right now it's just about playing the expectations of the rollout of the next chip and the GPU for Nvidia versus what we know is going to be a very strong earnings picture over the next couple of years for the company.
I'm hoping Jensen Huang actually clarifies how you pronounce the name, because I hear people say Nvidia, and I hear people say Nvidia, and it would be very nice for me to decide which one we're actually going to be talking about. You're talking about industrial policy fueling some of these ideas in terms of utilities, in terms of just industrial stocks more generally. Has that trade basically been played in the U.S.? And now it's really outside of this country that you're seeing new industrial policy put into place and not yet fully priced?
So the first answer is no, it has not been fully priced in the U.S. yet. With respect to the utility usage, the power usage, the water usage that's going to be needed to fuel the AI revolution that the U.S. is envisioning, it's going to require a lot more infrastructure and build out into really the picks and the shovels of the AI trade. So who's going to be providing the grid lines, the power lines, the water for the cooling? All of that, I think, is still very early stages. That said, while the U.S. at least has some focus on this sort of industrial policy going forward, you look at Europe and you look at outside of the U.S. and we're in very, very early stages. So I think we are likely to see a lot more investment and a lot more focus from a government side in terms of being able to provide the infrastructure in order to fuel the revolution that AI is coming.
Do you have any angst or concern that people are maybe getting a little too excited about Infrastructure Week on repeat? Just this idea, we were talking to Jack Caffrey of JP Morgan earlier this week, and he said it takes years to even get the permitting, let alone the actual picks in the ground. And people are using this as a play. They're using copper as a play. But we're not seeing the economic activity to back it up. It probably won't for a very long time. What's your fear factor with sort of overpricing at this point?
So I think that's a huge concern right now. I think that the market in some respects has run ahead of itself on the cyclical impacts that this is going to be, not on the secular. So I think they've probably front-loaded a lot of the performance. This is likely to play out over not just the next 3 to 5 years, but really over the next 10 to 20 years. And so, yes, I think that there has been a lot of optimism priced in the short end, but I think that you will see earnings continue to inflect higher. You are starting to see real ramps in some of these new chips, which are going to require a lot more power usage over the near term. And the challenge is that there's significant capacity constraints in terms of regulation hurdles in order to build out new power supply. And that's going to create, I think, keep prices elevated over the short term. But certainly there's a lot of sentiment that's positive right now. And so we're being very selective in terms of being dynamic in terms of how we're trading these stocks right now.
You like the United States, you're looking at Europe. What about Asia, where we see a lot of build out in the semiconductor supply chain and data centers?
Korea, we think, is a sweet spot for the markets right now. It's underowned. It's been, bought in the last couple of months, but broadly underperformed pretty significantly vis-a-vis Taiwan over the last year or so. You're starting to see an inflection now in semiconductor exports that just went positive over the last 2 months coming out of Korea. We think that's a real sweet spot. China, we're cautious on still. Certainly, we're starting to see some signs of the tides turning, but we think that China's stabilizing, not necessarily growing. And so I think that creates a challenge for investors really meaningfully sizing their positions in China, just because the property market, we think, is going to continue to be a fairly significant overhang on overall GDP growth. Looking out 12 months, as you look across the world, who do you think has the most favorable growth policy mix right now? Who do you think it is? So I think that the U.S. still does, just because of the fiscal overhang is going to continue to create divergence in economic growth in the U.S. versus the rest of the world. I think you are starting to see an inflection and stabilization in Europe. And so that means, given how sort of underowned and cheap Europe is, you can start to look back into European cyclicals in particular. But I think the U.S. by far is still going to be the outperformer with respect to growth. As that improves abroad, do you want to play that through bonds, FX, or stocks? You mentioned equities. What do I do with fixed income? So with fixed income, I think we like duration here, but really like European, UK, Canadian duration. We think that they're going to be much faster in terms of the cutting cycle, and probably more extended in terms of the cutting cycle than what's currently priced into market. Really interesting, when you look what's priced into markets right now across fixed income, they're all pretty much pricing in the same interest rate path. And so that to us is probably very misstated. Why do you think that is? I think historically you see convergence in terms of central bank interest rate policy. The Fed themselves are still expecting this to be a fairly normal Fed cutting cycle of 225 basis points between now and the end of 2026, with about 75 basis points of cuts each year. That's a pretty normal Fed cutting cycle. We expect that it's likely going to be more of a mid-cycle adjustment, and so you're going to probably see about half of those cuts than what the Fed is currently anticipating. And I think you're going to get some hint of that in the summary of economic projections in June. June 12th for the SEP and the Fed decision, same day as the inflation print. Erin, it's been too long. We haven't done this in person for years. It's good to see you. Thank you. Nice to see you too. Erin Browne of PIMCO there. To break it down, two of the very best, I'm pleased to say, joining us now, Bryson of Wells Fargo, alongside Adam Posen of the Peterson Institute. Jay, can I come to you first, sir? I want to get your review of the assessment from Governor Waller just yesterday. Given that inflation print from the last week or so, a C+ grade, would you give it the same grade? B-, C+. The good thing is it's coming down, right? And I think we're going to continue to see that as we go forward. The big sticky part here has been the service sector sort of inflation, and what we know about the leading indicators of housing prices. If you look at what's happening in rents in the economy, you're going to continue to see disinflation there. And then when you look at wage growth, we saw this in the average hourly earnings print earlier this month. Wage growth measured by average hourly earnings only up 0.2%. If you look at that and you annualize that over the last 3 months, we're below 3% right now. So all that's pointing in the direction of inflation continuing to recede as we go forward. Adam, to Jay's point, is there evidence building that things truly are downshifting?
Not really. We hosted Governor Waller yesterday for the speech, and I think what was striking, John, was that he was trying to put a dovish spin on what was actually a pretty hawkish message. He basically said, I have to see real slowing in the U.S. economy before I want to cut. And he ridiculed the fact, I think rightly, that, you know, they're parsing now the second decimal place on the inflation print, which I thought was very well taken from Chris. So I think the message is, no, they don't want to admit that there's a possibility they'll have to hike, but they are backing off cutting.
I love this. Fed speak is a Rorschach test, because earlier we had Andrew Hollenhorst saying that it was really a dovish message under the hood because several could mean anything. You're saying that it's a hawkish message. Are you getting anything from some of the commentary, considering that it really is sort of a choose-your-own-adventure, Adam?
Well, I watched before I came over this morning, Lisa. I saw Andrew, and like me and Andrew, I mean, we've been both on the same side on the Fed, calling that they were going to hike a lot and then calling they weren't going to cut a lot. And this is my first divergence with him in a while. I think you look at Mester, you look at Collins, you look at Bostic, you look at Waller, you look at all this Fed speak. It's all back to Phillips curve. It's all back. Even Chris, who was the one who said you could have disinflation with vacancies dropping, no unemployment rising. And yesterday he made very clear that at this point we're back on the flat part of the beverage curve and you would have to see unemployment rise. So I don't view it as dovish at all.
Jay, why do you sort of, I don't know, maybe disagree, or would you push back at all, saying that actually there still is room, especially if you get weakness maybe in the labor market?
Yeah, I certainly think that's true. I mean, things can fall apart really quickly. I'm not suggesting that's going to happen, but you were mentioning just earlier, you know, when you look at Walmart and some of those other retailers, you're starting to see cracks in terms of the consumer. You know, delinquencies are going up. You know, monetary policy right now, measured by conventional sort of measures, real monetary policy, real rate, still remains restrictive. And so I think you will see continued slowing as we go forward. Now, certainly not looking for a rate cut anytime soon. I think the Fed is going to hold the line on that and make sure that we're coming back to 2% on a sustained sort of basis. But things can downshift here pretty quickly as we go forward, and particularly is what we're seeing in terms of the consumer right now.
Adam?
Yeah, I think, I mean, Jay, I know well, and he's making a legitimate point, but I think downshifting in the consumer after the run of the consumer, the Nvidia-like run of the consumer for the last couple of years, is not necessarily portending. In fact, it's very unlikely to be portending a massive downshift. But more importantly, what the Fed's not allowed to talk about, but you here on surveillance and I and Jay and everybody can talk about, is what happens after the election. Right? You were talking a minute ago, Lisa, about whack-a-mole and targeted policies, right? So what happens after the election is probably we get fiscal boom, particularly under Biden. And if it's under Trump, we get a huge energy shift towards go, drill, baby, drill, and internal combustion engines. Either way, you're going to get probably an unsustainable boom in 2025. And I think the Fed's going to have to start raising.
You think they're going to be hiking interest rates again next year?
Yeah.
Really?
Very reluctantly.
How quickly,
yeah.
And what's the lesson, say, of 2016, 2017, when we were all waiting for those tax cuts? The Fed knew they were coming, but they couldn't change their plans until they actually saw them. Is that a decent experience?
I think, John, that's a relevant example. I mean, because they supposedly, the taxes from 2017 are going to expire by the end of 2025. And depending on who's in Congress and who's in the White House, there'll be a very protracted, messy negotiation. But if you're Biden, you have to spend more on defense, you have to spend more on energy, you have to keep spending on the industrial policy. If you're Trump, you're busy pushing out deregulation, tax cuts, whatever it is. Both of them are pushing towards a very big fiscal swing. And whatever result we get on the taxes, it's by the end of 2025, it's not going to be tax rates jumping up.
I'm so pleased you've brought this up, because I do think we're flying blind into 2025. I get the same feeling. And you're the first person really to come on this programme and actually sort of lay out what you think is going to happen, and why you think the Federal Reserve is going to have to hike interest rates. Lisa, I've not heard that before on this show at all.
I got something to talk about.
Well, yeah. I mean, I'm sitting here thinking to myself, if you have a boom on top of what we've already had, that's a real boom for stocks and a real negative for bonds. Jay, what's your reaction to that?
Well, so what I would say is, you know, we're talking about President Biden, we're talking about potential President Trump. It's really going to depend on what the congressional makeup looks like as well. And so in order to get those big fiscal swings, you pretty much need to have Congress and the White House kind of aligned. And if we have a split decision come November, and nobody knows what's obviously going to happen, but, you know, we'll see what happens there in terms of fiscal policy. But between now and the end of the year, I mean, we're still looking at $5 5 months away of that, and I could potentially see a lot of downshifting here in terms of the economy, and potentially you could see some Fed rate cuts at the end of the year. But a lot of it's going to hinge, as Adam points out, a lot of it's going to hinge on what happens in the election, and again, what the election outcome is in terms of not only the president, but in terms of what the congressional makeup looks like as well.
And Jay, as John was pointing out, it's very hard to have any visibility whatsoever into what's going to happen. Adam makes a very compelling case for why either way you'd get a fiscal boom. Either way, though, why would the Federal Reserve want to cut rates ahead of that, knowing that there could be some upside that could force them to reverse course?
Well, again, I'm not looking for them to cut rates anytime soon. I mean, I think the potential earliest you would see a rate cut, and depends on what's happening with the data between now and then, would be in September. The election obviously complicates that a little bit as well. There's another FOMC meeting right after the election, 2 days after the election. Do they cut rates there? I mean, that's going to complicate things as well at that point. But they're really going to have to see how the smoke clears. And again, because you're going to potentially get a fiscal boom, it's not going to happen right away. I mean, and so this is going to be legislated sometime in 2025. We're still at least a year out from things being legislated, and the Fed will be responding to where the economy is at that point in time.
Jay, I'm glad you brought up Congress. Adam, this kind of idea you have about the Fed having to hike because of this fiscal spending is dependent on the makeup of Congress. Biden, if he was going to spend like that, would need a Democratic House and a Democratic Senate, correct?
Yes and no. Anne-Marie, you're absolutely right, but I think less so than in the past, because remember two things. First is that the bills already passed in IRA and CHIPS, they're mostly open-ended subsidies. They do not require reauthorization from Congress. They can be interfered with if Trump comes in, but that spending goes. Second, that the defense spending generally gets taken out and voted on separately, and often bipartisan, or at least more bipartisan. So I think two of the big places where you're going to get spending are not going to be subject to withholding by even a Republican Senate the way it might have been in the past.
Interesting. Jay, I just wanted to come back to you on this downshift that you're looking for. I'll ask you the question I asked Andrew. Can you put some numbers on it? With a 3-month rolling average on payrolls north of 200K, what are you expecting to see later this summer? What does that come down to? Andrew said sub 150. What are you looking for?
Yeah, we're looking for roughly the same. I mean, if you look at our average for the third quarter, I think we're looking at 150, and then slowing to roughly 120 or so by the fourth quarter of the year. And we're also looking for the unemployment rate by the end of the year to be up to 4.1%. You know, and if you believe in the Psalm rule, if you get up to 4.1%, then the economy should be tipping into recession. Now, we're not looking for that, but we are looking for sub-trend economic growth later this year. Prints of less than 2%, not being dragged down by inventories, not being dragged down by a big import surge, being dragged down by downshift in consumer spending, and as well as investment spending that is lackluster at best.
Jay, this was great, super thoughtful. Jay Bryson there of Wells Fargo, Adam Posen of the Peterson Institute for International Economics, still with us around the table. Adam, I wanted to save some time to talk about trade.
Yeah,
You've got some really strong thoughts on this, and I think it's going to be a valuable portion of this program this morning. Do you think we're turning our back on economic liberalization at a time when global challenges actually could benefit from it?
That's a great big picture question, John, and I appreciate the fact that you and Lisa and Marie keep coming back to this. It is a huge shift, whether it's Biden or Trump. Biden, I think, is drawing the line at some of the most crazy Trump tariff policies that are proposed, but he's done nothing to reverse and now added on some. There's an anti-China element, which has national security overhyped, but there's more about what this does to U.S. relationships, business relationships, technology, market opportunities, investment flows throughout the world. And we've been writing on this at Peterson Institute. We just published 2 days ago a great new piece by Kimberly Clausing and Mary Lovely on how the proposed Trump tariffs would be a huge hit to middle class and especially working class families. So what they did was they looked at the proposals through the lens of being taxes. So you had David Malpass on talking about tariffs as taxes, which they are. And so they used the same apparatus people look at tax increases for what's the incidence, meaning which parts of the income distribution get what and lose what on net. And the average American household would lose $1,700 a year if the Trump tax cuts went through. if the Trump tariffs went through. And the distribution is highly regressive. So even if you continued the tax cuts from 2017, you would still on net be hurting the lower 10, 20% of the income distribution even more. And this just goes to what you were saying, Emery, about how purchasing power of households, feelings of inflation, feeling of high prices, which sometimes gets muddled, but anyway, is really core. And so Biden could make that better by cutting tariffs that were left to him by Trump that are not national security, not China. He could do it through executive order, boom, increase people's purchasing power. But the worst thing is if they go crazy, as convicted felon Peter Navarro said in an interview, that this is the policy that Trump's going to do. If they actually do the policy they say they're going to do, they're going to cost American households.
We had David Malpass on. You referenced that conversation, and he was saying that lower taxes and targeted tariffs could be a growth policy that will actually get the U.S. to a place that could allow the deficit to be manageable. Do you agree?
No. That's essentially what the right-wing populist governments tried in Latin America in the 70s, 80s, and 90s, and it was a huge anti-growth policy. There's a reason the World Bank, which David used to run, has recommended against that for development for millions of people around the world. It's taking the U.S. into banana republic territory. It is revenue positive for the Treasury. I mean, that is true. But when you're choosing how you're going to raise revenue, it's one of the most distortionary ways to raise revenue with the most negative impact and the most intrusiveness of government. And mostly when people like David Malpass and others talk about the advantages of tax cuts, it's about getting government out of business's way. Tariffs are the most intrusive way you get government into people's decisions.
Unlike concerns that you have about a fiscal boom next year, which is reliance to get a lot of those things you're talking about, the makeup of Congress, Trump could come in and edit tariffs immediately.
Yes.
So how inflationary can those be that the Fed needs to start thinking about within days of a potentially Trump 2.0?
You're right to raise it, Emery, and I think that's a key point, that both Biden and Trump, but especially Trump, is able to do a lot of stuff through executive order. So he can change migration policy through executive order. He can raise tariffs through executive order. He can bar foreign direct investment through executive order. He can change energy regulations through executive order, all of which is boom. And the levels of inflation we're talking about, if he does that, we're about to release some studies of this later in a few weeks, I hope. But, order of magnitude, you see a jump in inflation 1 to 2% immediately just on the tariffs alone. If you do the kind of crazy, inhumane migration deportation policy they're talking about, we're seeing much bigger numbers because you're completely disrupting labor markets and causing shortages of certain types of labor beyond the human cost. And creating huge uncertainty for small business. So you're looking at very large jumps in inflation, and the Fed may not want to explicitly address that because it's seen as political, but I would put the odds of them being able to do the cuts in 2025 as very low.
Wow. We're going to have a lot to talk about this year. Look forward to covering it with you. Adam Posen there of the Peterson Institute for International Economics. President Joe Biden narrows the gap. The two are separated by no more than 2 percentage points in Michigan, Pennsylvania and Wisconsin, according to the latest Bloomberg Morning Consult poll. Jennifer Flitton of Invesco writing this: like 2020, this presidential election will likely be decided by less than 10% of voters in the battleground states of Arizona, Georgia, Michigan, Nevada, Pennsylvania and Wisconsin. Jennifer joins us now for more. Jennifer, going into year end, going into November, what are the policy options that the White House has left? What levers can they pull?
Well, I think they just did one this past week in announcing the release of oil reserves. They're going to have to try to find some way of affecting those prices that people are feeling when they go to the gas tank, when they pay for the food, when they're looking at their mortgage rates right now. The Fed isn't very helpful. And so this administration is going to have to do things that at least allow for the feeling of the economy loosening, right? For folks to feel like more is in their pocket. Because right now, compared to 3 years ago, everything just costs more.
Jennifer, one policy lever potentially the White House may pull again, they did this morning, and this has to do with student debt. Does that resonate with the electorate?
I think it depends on who is affected. And sometimes it actually sort of alienates those who don't go to college. We sometimes forget that there's a huge segment of the population of people who don't go on and further educate themselves post high school. And those blue-collar workers or small businesses, entrepreneurs sometimes, those folks aren't affected by that. And sometimes there's a disconnect between those who feel like they're paying for those student payoffs and those who are actually receiving them.
Looking at Michigan, Pennsylvania, Wisconsin, it is very, very tight, and our latest polling data shows that amongst a slew of other polls that have come out in the past few weeks. How critical are these three states to Joe Biden? I mean, can he even win without holding the blue wall?
Yeah, that's an excellent point. That is exactly what he has to do. I mean, his pathway to a second term is through the states of Pennsylvania, Wisconsin, Michigan, and then biting off one of those Sunbelt states. And it's sort of the reverse for Trump as we're looking at these polls, that his best route is probably through Nevada, Arizona, Georgia, and then biting off one of the steel belt, the northern states. So, this is where their focus is going to be. And we're 166 days away from the election. We know it's going to tighten, and it's going to tighten further once folks really start focusing, which is when the kids go back to school in September.
Jennifer, a lot of people have been talking about not voting at all because of Israel policy. At least we hear a lot of articles about that. We hear a lot of people saying that vocally. Are we overstating just how significant this issue will be to getting voters out or keeping them home in some of those blue states, in some of those swing states?
Yeah, yes. I think once you do the crosstabs, I mean, you're going to find demographics. You're going to find people, swing voters sometimes are those who are willing to swing, progressives, young people. These are folks who aren't necessarily going to go and vote for Trump, but they may stay home. They may have their vote depressed. And that really matters when you're in a state like Michigan and, you're 10,000, 20,000 voters that you're really pining for. But I think the fundamentals of this election are still staying true, and we're seeing this in polling. It comes down to the issues of inflation and immigration, crime, and then on the other side, abortion and sort of that democracy chaos sort of issue on the Democratic side.
Is there anything the Biden administration could do around inflation, given the fact that it might be actually decelerating, but the inflation that's baked in isn't going to change between now and the election?
Some suggest that it may be about messaging and having a better message and looking forward to the future. But I think you've hit on the question, and that's the question that the Biden campaign are wrestling with, sort of constantly, and they probably will up to Election Day, especially if our economic circumstances and the way that people are feeling the economy stay the same.
Jennifer, forgive me for the home bias, but I want to talk about financial regulation and the future of it as well. The head of the FDIC is stepping down. We can talk about the why. The bank lobby, or the common sense lobby, seems to have won out over capital requirements potentially being unveiled over the next several months as well. What do you think the future of financial regulation is going to be, regardless of who wins the White House come November?
Well, and I'll first say that Mr. Bloomberg has announced that he will resign, but he'll step down only when his seat is filled by a confirmed new director. So, our chairman. So I do think that we may have a little more time with him. And then, of course, the bank lobby, to your point, there is a real push to get a reproposal. And I think the FDIC and OCC would potentially just like to make some minor changes on the Basel III issue. But the Fed seems to be a little more open to reproposal. And you're going to see Congress continue to push on this issue. There have been some really interesting hearings where you've seen some bipartisan concern with the proposal and the request for reproposal. So I think this is going to continue to play out throughout the rest of the year.
Do you think we'll see anything substantial when it comes to this ahead of the election?
Well, if I had to sort of armchair sort of, look at this issue as the likelihood of the time that we really have here in Washington prior to the election, I think it's unlikely. But I do think it's very possible that we see a reproposal. I know that many folks downtown and those who are on the Hill are constantly working to see that happen.
Jennifer, I know you focus on policy, and one of the biggest policy fights next year is going to be taxes as well in terms of the financial umbrella. What are you expecting in terms of the extension of the Trump-era tax cuts? At what level do you think they get extended?
Well, and no matter who is president next year, you're right. In 2025, we have a number of provisions that are expiring from the TCJA. It was passed in 2017. It's going to look very different depending on the makeup of Congress and the presidency. So much is riding on this election as it relates to tax. And so if you do have say it's a Trump presidency with a majority in the House for a Republican and Senate, then you could have a much larger sort of reconciliation package on taxes, something similar to 2017 in its breadth, right? But if it is a Biden presidency and you have a split Congress, it's really going to have to be a negotiated package because you have a number of different provisions from SALT to the individual tax rates and child tax credits. Those are all going to be part of the negotiation. So it's going to have to be a bipartisan package.
Jennifer, we're about 8 minutes away from the expected release of Target earnings. And this comes at a time when, just to go back to your point earlier, it's going to be really key at this White House to see what kind of messaging they can do to make people feel better about the fact that things are more expensive than they were 4 years ago, 3 years ago. The White House came out with this on Monday, basically calling on grocery chains to lower their prices, welcoming the fact that Target had lowered prices, saying they are delivering. Is this what will win when it comes to messaging?
Yeah, that's a great question. I think we saw this in the State of the Union, this whole idea of shrinkflation and sort of forcing the issue onto corporations, onto those who deliver services, onto those who deliver goods. I don't see that is where Americans are focusing their concern. And I do know that, as far as institutions go, grocery stores are pretty high in the support of the American people. Institutions in Washington, much lower. So I think that might be a difficult one to sell to the American people.
Jennifer, thank you for your input this morning. Jennifer Flitton there of Invesco.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.